If we could mute the crowd too, Ryan, thanks.
All right, we're live.
Okay, Portfolio Builder members, welcome to our Friday the 13th Trade Alert. As we've seen, we've been tracking the correlation and percent change of SPY against the TLT, expecting these two to cross over. And now I can zoom in and out of different time frames and make that crossover already, but the general idea is that money is being pulled out of the stock market and will soon be accumulated into the bond market. And the reason why is because we have a crisis that cannot be solved at the private level, at the private sector, and will require government intervention. So there's a limited supply of resources in the economy, and with the coronavirus disrupting the industry, we're going to need to pull together every penny we can as a country and push it through the government, which will then redistribute that into the important sectors that are hurting. So this could mean just trying to keep our airliners on life support, our oil companies on life support, numerous businesses just simply on life support. I think the main benefactor will be healthcare, biotech, and medical supply companies. So I do believe we're going to see a massive crash and that we're only 1/3 of the way down. And at that point, we will be ready to buy the dip. Now, normally we'd be trading the SPY Monday, Wednesday, Friday, but I do want to give everyone a heads up. There are 3 specific ETFs that I plan on us buying once I do believe we're near a bottom. That I believe will be the direct benefactor of the money that is about to be raised in the bond market. I believe that will be nothing short of trillions of dollars over the course of the next 2 years. So we're looking for a massive crash, a huge rally in the bond market as government raises capital and then begins redistributing it to the parts of our economy that are in desperate need. If we go a little lower, we can see the trade alert stay in cash. You're actually now maxed out with today's trade in terms of how many call options we can purchase. If you've been following us and holding, if you're brand new, then again, I do not recommend going back in time to take old trades because some of these trades, despite going below our strike, are still up, and you're really best off following the trade alerts as they come. So let's just read this verbatim and then go through it all. So the recommendation is to stay in cash, although we have most of that cash parked into TLT call options and 2 GLD call options. Now, I think that the bond market has to move first, then we'll see the big push in gold. So I may have been a little early on that, and I'm still considering whether to hold that position or not. The big scheme is that there's massive stimulus and quantitative easing happening alongside rate cuts. So a lot of people love to pull up a chart of 2008 and say, hey, gold went down with the stock market. And it didn't go up till 2009 when the stock market rallied. But the key to remember is that we did in 2008 rate cuts, which essentially guarantees a stock crash if you know how the bond market works. And then we did QE in 2009. So now we're doing both at the same time. This is going to most likely be detrimental to the stock market in the short term and very bullish for bonds as well as gold. Now, once again, if you want to know why bonds and gold are down this week, even though we're having panic at record levels, the only time we've seen stock crashes to the magnitude we saw this week, you have to go back to 1929, right before the Great Depression. So people were over leveraged, selling put options against oil and stocks. Smaller banks were loaning money to shale companies. All of those were exposed and put into not just 100% losses this week, but multiple 100% losses. So my expectation is big banks gobbling up the little players, and they just had to liquidate everything. So that's really the only way you explain seeing every single asset go down this week, from bonds to gold to crypto to stocks. And this is with $1.5 trillion QE package that just came through yesterday. Next week, again, I do expect the rate cuts. Okay, so you are currently long a 320 TLT call. We'll most likely sell this. If I see the TLT get back to 180, I think that is going to be a short-term roof or ceiling where we will look to take profits this time around. So I may unload a group of these TLT call options. And if you're in our pro membership, I may even take TLT off the table for a short period of time if we get to that level in the next 2 to 4 weeks. So that quite likely could happen. And I think people will take profits and we'll get a new opportunity to jump back in like we saw on Monday. So I do believe eventually we're going far higher than that as we see central banks push into negative interest rates around the world. The United States will be able to start giving future guidance that they're willing to do the same. So we are currently long the 320, the 327, the 43, the 49, the 417 TLT call options. Most of these are all at the money. If you're in our pro program, you have an even more aggressive trade with a lot of time premium. I'm not revealing that trade here. This is just for our basic membership, what we're currently holding. You're also long the 49 and the 417 GLD calls. And again, I'm well aware of the pullback in GLD. It makes absolutely no sense with the massive QE that's currently being deployed. And the only real explanation is that people were blown out and had to liquidate all assets, regardless of whether they were losing or not. Okay, so the trade alert today is to buy 157 TLT call expiring May 15th of 2020 with 63 days of expiration. Now I use the ask price for our track record, which is screenshotted and circled. If you're a good trader, you can probably play around with the mid price, bid a few cents higher. If you don't get filled, cancel, refill, replace your order. Here's the key chart you need to understand if you're playing the bond market. Bond market's not like a company. There's a limit to how high it can go based upon what your central bank's interest rate policy is. Now look at the red line. This is the Fed funds rate, okay? So as they have gradually dropped this lower and lower, interest rates have gone on your treasury products lower and lower. The lower these go, the higher the TLT rises. So again, we just saw China cut rates. We saw Bank of England do rate cuts. We did an emergency rate cut in the US, which gave us this first pop to 180. And again, I do highly anticipate a immediate cut next week down to 0. So then the bond market will start trying to speculate whether or not we eventually head to negative territory. So we most likely will have a profit taking opportunity within the next 30 days. And that 180 level is something I'm looking at for a short-term exit for profit taking, and then look to buy into any dip for the next big move, because I do believe we will have to push towards 0 on the 30-year, if not into negative territory. The trick is we can't do that until other central banks have already cut their rates lower to allow us to still have that spread. Okay, so we're down a little bit. We went from up 15% on Monday to down 4.6%. So that's not fun. The explanation is, once again, people got blown out. We made the right prediction that there would be a stock crash. What I did not anticipate is that it would put people into insolvency to the point where they'd have to liquidate all assets. Now, what did the Fed do yesterday? They came in and essentially created the Fed put for the bond market, not the stock market. So they've come in and said they're going to start vacuuming up all of the spikes in interest rate treasury sell-offs because they know what comes next. They need to raise trillions of dollars to incentivize that money to buy and hold bonds. Investors either need to love the yield, and I can tell you nobody loves this yield. 1.5, that's not going to cut it. So the only way they can achieve raising the billions and likely trillions of dollars that they need to survive this crisis will be to incentivize the big banks to buy bonds. So right now, I would expect that the insiders who know what's going on are trying to get as much of their stock portfolio sold as possible in every little rally. They're using the media to do their best to keep you holding on to your stock portfolio. And the smart money is loading up on treasuries. And really the most leveraged and attractive product is this 30-year treasury because it does have the most room to cut in terms of its yield and appreciate the bond. And it's 30 times leveraged compared to, say, for example, the 1-year bond. So we have a small drawdown. This year, we're down 4.6 in 2020 for our basic program. And that's just because of this pullback in the TLT from all the blowouts. I do expect by next week to be back in the green. And I do think we will beat the return we had on Monday because the big crash is unfolding as we speak. The pro track record is a little different than our basic program. And you can see it has less volatility. Just in general, it has less volatility because it's not using so much of its capital to play the options market. So we actually have about half of our capital owning the underlying asset instead of just using these leveraged call options. So if you're in the pro program, you have 2% drawdown and are poised very well for what I believe comes next. Now, if you are a member of the pro program, this trade alert is only related to how much capital you plan to put in our SPY trade alerts. It does not have to do with your TLT GDX position. Our buy and hold portfolio has not changed its strategy yet. We have 3,000 in cash on standby to buy the SPY. However, I do intend to buy a healthcare, biotech, and medical device ETF and use a weekly option strategy when the time comes. I do believe we're only about 1/3 of the stock crash, so we need to be patient. Look for the VIX to pop above 100 in the coming months. So we have a lot of cash in our buy and hold ready to buy stocks. This one does no option trading, so it's just sitting ready to buy the dip. It has 20 shares in the TLT, 20 shares in GDX, 10 shares in Yang. That's the inverse of large cap Chinese stocks, and an additional $440 in cash to potentially double down in this position. So it's down 1.2% in 2020. So a little drawdown today, not worried. We can easily understand why our positions aren't performing when they should have. We had the right prediction this week in terms of what the stock market would do, but we did underestimate the impact that stock crash could potentially have on people who are over leveraged. So I think these losses have been pretty much absorbed this week, and now I believe we see the next big move. Now I want to go back through a few trade alerts just to see the animation of this unfolding. We'll look at some other charts, talk about what the Chinese propaganda arm is spouting right now. And we'll look at the growth of the coronavirus, and we'll go into Q&A. Okay, so I've been shouting out loud about a crash since I believe early, like the February 1st, when we saw that there was a virus that was spreading at an exponential rate, and it has never stopped spreading at an exponential rate. So we've been warning everyone of this. This was on February 28th. I haven't gone all the way back. Last chance to get out. Okay, here's when we started showing this correlation. You can see this jawbone closing in. This is approximately every 48 hours that we have a trade alert. Closing in, getting even closer. Now they're touching. Now again, if I zoom in and out on the time frame, I can make that pop in and out. It's just, you need to understand resources are now being pulled out of the private sector into the US bond market because we need to gather these resources to keep key industries solvent, maybe not thrive, but we just need to keep them alive. And then we're going to need to put a lot of money into the healthcare sector to survive what's coming up. Here's your yield curve. This is highly affected by the federal funds rate. If you have a stock crash, let me pull up that chart. Everybody nervous should just take a look at this chart. Okay, so let's look at what we've done in every single stock crash recession. Okay, here's stock crash. What did they do? Federal funds rate was cut dramatically. That forces the value of bonds to go up. Next recession, rate cuts, massive rate cuts, bonds go up, stocks go down. Dot-com bubble, what did they do? What did the Fed do? They cut rates. Did that save the stock market? No, it made bonds go up. 2008 crisis, what did they do? They cut rates. It makes bonds go up. So the key is the government raises capital. It incentivizes that investment by cutting rates, which makes the value of those bonds go up. The government tries to absorb the losses and fix the underlying problem. And then once the underlying problem is resolved, they go buy those bonds from the banks for a big profit called quantitative easing. That allows the banks to now have a ton of profit from investing in the government's bond selling, and then they go up and buy stocks. And the most criminal part of this is they're buying stocks up at 50% off what they used to be, while they use the media to tell you to buy and hold. So I'll never forget, in every major stock crash, Warren Buffett and Bill Gates will come out on TV and tell you they'll never sell. So meanwhile, the banks slowly but surely take over ownership of all of these big corporations. At pennies on the dime, they take advantage of the bond market and their control over the central bank for guaranteed profits. They use the media to confuse the normal investor. And they've done this over and over and over again. Okay, so here's that comparison chart of the SPY and the TLT. And again, I can zoom in and out and make this look however we want. But the big picture is there's limited resources in your economy. And right now, the underlying economy is in serious trouble. So the government's going to raise capital through the bond market and redistribute that resource into the key industries. The goal will be to keep key industries alive, keep the labor market working as much as possible. And then I believe they'll have to hand hundreds of billions, probably trillions of dollars into various healthcare companies to deal with. I'm not thinking 10 times the normal hospital expenses that America has. It could be up to 100 times. This will be key to keep an eye on. So far, this is the auctions of the Treasury. So first we have to go make the bill for the spending, get it passed, then the Treasury will start ramping up the size of these purchases. So far, these are completely normal. The repo is interesting. They came in and increased this to be $500 million max, and nobody took it this morning. And apparently that's because of all the regulations that have been passed. The banks really have their hands tied. So we'll probably see the banks get deregulated pretty quickly as well. But we have seen a lot of stresses on the repo market recently. And this is an indication that banks are out of money to use to loan into the economy. Here's the Fed's balance sheet report, which came out yesterday. And again, they are starting to grow the balance sheet. Now, normally they do this once again after the crisis has been resolved. So the game plan, once again, is once you screw up something royally in the economy that the private sector can't solve on their own, then you use the government to raise capital, fix the problem, do rate cuts during this period, because it's the banks really who primarily buy these bond products. And then they use quantitative easing to allow the banks out of these bonds for a big profit, and then they come in and buy stocks. So right now, we're doing rate cuts and QE at the same time. So this is the primary reason we want to be long gold, and the expectation of rate cuts is why we want to be long bonds. So the next big rate cuts probably coming either Monday or Wednesday. The official meeting is on the 18th, which is Wednesday, and our first TLT call option expires Friday. So I do think we'll likely hold that all the way through Friday. And again, if I do see us touch 180 on TLT, I'll probably pull off a lot of profits and then consider what our next move is from there. But I do believe that the necessity to raise capital through the bond market's just getting started. We're not even seeing it show up in the treasury auctions yet, because once again, we still have to get all these budgets and bills passed before we start selling the treasuries. Okay, okay, next thing I want to look at, again, this is what so I started off, the way I've kind of was able to catch the stock market well before it occurred was my whole thought process for this year was, and I want to pull this up. I'm going to pull up a chart from the image from the South Morning Post that I went back because I remember this clearly.
I'm going to post that link in the chat, Jay.
Okay, great. Yeah, if you could post that for me. So we were in this 2-year battle with China where we were aggravating them, sanctioning different companies, putting tariffs on them. China seemed to just be deflecting it and reciprocating whatever action we did. They were doing it right back. And it didn't really look like they were going to agree to our terms. And then all of a sudden there's this trade deal. And leading up to that, Xi Jinping calls for a new long march in a dramatic sign that China is preparing for protracted trade war. Xi Jinping told cheering crowds in Jingxi, "We are now embarking on a new long march, and we must start all over again." Okay, so what I was anticipating was that we probably would not have a trade deal. And so we were playing that relatively defensively last year. Let's see. We ended up with a 14% return in our SPY program and a 14.8. But if you've been following me for quite some time, I really didn't think China would be willing to give up its competitive edge. And that edge that they have is to work as a single unit. So they work as a collective whole and not as a bunch of individual pieces. And so that allows them to essentially make a ton of money manufacturing. They tax the citizens at a 70% rate. The entire country's controlled by a small group of the Communist Party. And then they're pulling all of the resources of the entire country and laser focusing it into key industries that they believe will be massively profitable in the future. And so one of those companies that's disrupting markets is called Huawei. And it sells more phones than any other phone company in the world in terms of total number of phones. But they're wanting to get their hands into all sorts of important sectors. The problem is if they have a $1.5 billion population and a $13 trillion economy, and they tax their citizens at a 70% rate and then pool all of those resources and put it into a handful of key industries, then no one else will be able to compete. So it's allowing them to just dominate at sectors they wish to dominate. So that, in a nutshell, is really what this trade war is all about. And so I didn't think China would be willing to give up that competitive edge. So we came out with this phase one trade deal where they're going to buy agricultural products. And then all of a sudden it went from 50 billion to $200 billion. It really didn't make sense. Now, the other thing is that they knew about this virus way back in November. The doctors who first found it were all thrown in jail. And since then, they've lied about the impact it's had and how deadly it is for the last, 3 months now. And now their propaganda arm is now telling everyone that it's probably the United States that actually started this virus and gave it to China. And they sit there and ridicule how much better they've been able to deal with this than the United States. So it does not add up. The speech President Xi's been giving to his Communist Party does not line up with, hey, let's bow down to America. We're seeing the Russians start a oil pricing war with our ally. So to me, this looks like we're on the verge of at least a minimum of a financial war with China and Russia. So that's, at the end of the day, I think that's what this will boil down to. So anyways, you had to take the news for what it was. Stock market was shooting up to all-time highs. There's this supposed trade deal. Stocks should have gone up. Emerging markets should have outperformed US equities. That's what I was really watching. But it wasn't. And about a week leading into their big holiday, where there's massive traffic flow, they shut down all of China. Emerging markets crashed while US equities were going up. And that was something that should not have happened. So my eyebrows were raised immediately. And I could not figure out what on God's green earth would make China's stock market go down when they just signed this historic trade deal. In fact, part of the trade deal appeared to be that the US banking system were planning to buy their bad debts, essentially fund the Chinese plans for their Belt and Road Initiative. This should have been extremely bullish. My prediction was that Treasury yields should be rising, not falling, and that we're going to have good growth this year. That China, for once, should actually outperform the US stock market. Its PE multiples were lower, 15 relative to our 18.6, but pretty quickly that was not happening. In fact, their markets were crashing. No one knew why. And the only story you could find was about 30 cases of the coronavirus. Then it was 70, then it was 140, then it was 300. Then by the next weekend, it was up to 1,000, then 3,000. And I started collecting all the footage out of China, and it's nothing short of horrific. But yet they want to tell us that it's 3,000 deaths in China. There's more people in the United States that die from using power drills with their left hand than there are from what China's claiming is the coronavirus. So I'm afraid I think this is going to get much worse in the very near future, and it's time to buckle up. So that's why we're positioned the way we are. The hopeful news, it does appear there's a drug called chloroquine that's some sort of zinc that is turned into a salt that can get into the cellular level. That seems to be helping reduce mortality rates. So that's one good piece of news. The other news that I'm tracking is hoping that Singapore can really deal with this because their temperature is between 80 to 100 at all times. They have a world-class healthcare system. If Singapore can't keep this under control, that's very bad news. Now, I don't think you can assume that if Singapore does it, other countries can. And we're really not sure. And we're really not sure if the summer heat will really do anything to help us here. Okay, so that's a review of what we're looking at. The other key thing you can watch now, you got to realize that there's a scandal going on here in the States, not allowing people to be tested. So the second they really start rolling out massive testing, first of all, this is a log scale. So keep in mind that this on the left is 10, 100, 1,000, 10,000. So that shows you if it goes up at all, that's exponential growth. It's just an easier way for humans to understand exponential growth. If you remove the log scale, it looks like it's going straight up. So if it's going log scale and it's traveling higher, that's very, very bad. And at this point, I highly doubt we're going to be able to stop the spread of this virus. So now the solution is to contain, and that involves shutting down the worst outbreaks and forcing everyone to stay inside for weeks, sometimes months at a time. The cost of that is, of course, slowed economic growth. So I do suspect we'll see negative GDP growth Q1 worldwide. And again, that could push interest rates into negative levels and US Treasuries into negative ranges. So if we get anywhere near the zero on the 30-year, that puts TLT way above 230. If we go towards what the German 30-year yield was last year, then we're looking at a $300 TLT. So I'll be paying very close attention to that product. But that's the big picture in a nutshell. We have a little bit of pullback in the bond market. I've said this a million times. People were selling puts against oil. They were making loans to smaller oil companies who thought they could have a great year, probably over leveraging because oil was going up. Everybody thought this was going to be a peaceful period of time between US, China. And I think the exact opposite is quickly unraveling here. So bankruptcies are causing mass liquidations. That's all being absorbed. Considering the magnitude of the crash last week and likely the magnitude of bankruptcies, you can see the TLT is not really budging that much. So I would call the TLTs crashing. And I think the next move is far higher. Okay, great. Let's go ahead and first look at the chat.
Hey, and Jason, I just want to tell you, but you were literally the first person to tell me the word coronavirus.
Yeah.
Great job on being just so early. Just literally before anyone I knew, anyone in finance. It's a great job on that.
I was following it from day one. Okay, so Malvis says, why is TLT crashing? It's pulling back a little bit, buddy, but it's not crashing, and I believe it'll go much higher. Kathy C says, I just freed up another 75K. Please review if I'm doing this correct. Keep 35K in cash, 200 TLT, 400 GDX. So in the buy and hold, I haven't yet made that, but you're very intuitive. And that's what we did in the pro system. So I haven't made any adjustments to the buy and hold recommendation, but
Kathy has the pro, Jay.
Right. So she's following the pro, but I think, are you trying to do the buy and hold or the pro?
I think she follows buy and hold in a smaller account.
Yeah.
You guys
Oh,
are
yep.
good. Yeah, I'm following a buy and hold in the smaller account using $750 at a time. But this one is really for the pro.
Okay, so the pro, I would follow yesterday's instructions with the married put.
So I need a put in there too.
Yeah,
Okay.
I wouldn't be leveraging up on gold without the put, because if there's more people getting blown out, there could be more downside on GDX. Now in 60 days, so the bet I have on GDX for the pro members is we bought the in the money put So we have no loss. We basically, our put option is the maximum loss, and we're betting that it'll go up more than the cost of the put. So yeah, I would follow the pro on that one. If you
Okay.
want to go to 400 level. Okay, Michael Seebeck says GLD call. So yeah, if you think they're doing quantitative easing, Mike, so here's the proof that they are. They publish this every Thursday. This is called their H41 release. Comes out at right after the close every Thursday. They tell you what they've done with their balance sheet. And so I review this for you guys every Friday. Key change that they were not doing before. They're starting to buy up the bonds, which I believe that's basically your PAL put. Everybody talks about the PAL put for stocks. Well, now they have to do the PAL put for treasuries because they need to raise a lot of money. But they grew the balance sheet by 77 billion. And I expect that to get much larger. In fact, they've issued up to 1.5 trillion in liquidity, but yet that's not been, the banks are saying they can't take it yet, even though they want it because of all these regulations. So I think we're going to have to see some regulations removed. And then all of a sudden these banks are going to take as much capital, liquidity as they can and buy bonds. So yeah, we're down, GLD's down. It's a tiny market cap. It can go back up quite quickly. At this point, I've made no change in the GLD call options yet. Randy says, hi, Jason, what's the reason? What's GC? It's going so low. I assume GDX is correlated. Is that why?
The futures gold contract.
Oh, okay. Yeah, market manipulation. If you're doing QE, you want to own gold. So there's a lot of people who got blown out, bankrupt, selling everything this week. Central banks are going to do whatever they can to trick people into buying stocks. But bottom line is, if they're doing quantitative easing, if they're expanding the balance sheets, if they're printing money, just think about it. There's a limited supply of gold, and every central bank around the globe is printing right now. It's going to make the relative value of gold go up. So I would ignore the noise. And as soon as I see a massive run up in TLT, expect me to get quite aggressive buying more GLD call options. That's going to be the two plays we're going to rotate in the basic membership until it's time to come swoop in and buy those healthcare ETFs. And that's probably at least a couple months away. So yeah, if TLT is low, that's my favorite, and I'll be buying call options on that. So if there's any kind of pullback TLT, we're going to load up on those long calls. Once that gets overpriced, probably a short term, 180 is a good level to start pulling some profits off. Then I'll look at loading up on GLD call options. I don't want to own GLD because I don't like the bank that owns it, which is HSBC. A very corrupt bank. So call option, we have a limited risk for a very short amount of time. And so if they did turn out to not actually have the gold they promised and went bankrupt, we're out the cost of the call. GDX, however, is American Canadian mining companies. So think about it. If spot gold's going to stay, let's just say it stays above 1,500, not even 1,600. Jeffrey Gunlack thinks it's going to 2,000 in short order. Well, oil costs are down, so mining costs are down. They're already mining these ounces of gold for about 750 to 1,000. So they have a huge profit margin. The fundamentals make a lot of sense. So haven't changed my opinion on the gold market, despite the pullback. I'd say it's just noise from people getting blown out. Gary.
Yeah, I have a question on that same topic. Just a thought, and it was, given that GDX is the mining industry, is there any chance that the mining industry is going to get hit by this coronavirus like all the other industry?
Well, I think they're gonna have to pay him a little more, but I bet you they go mine that gold.
Okay. Yeah, I guess they would probably have to do that, especially if gold. I was thinking maybe gold might be better, but if the price of gold goes up, well, high enough. yes,
So
they would-
yeah, so I like to speculate on spot gold with call options, and I like to own gold miners with real capital.
Okay.
So that's kind of the thinking behind that. So yeah, spot gold goes up first, leads the path, and then all of a sudden you see, I think one day you're just going to see GDX, just a big player like Stanley Druckenmiller comes in and just shoots it up 10, 20, 30%. So I'd rather just sit there, let it float around. We got the put option on it, so there's no risk beyond what we paid for the put. And I believe one day you're going to see big money just push the hell out of those.
That'd be sweet.
So Kathy, I really don't want to be giving away our pro product for free, but you have that from yesterday, right? Tony L, go ahead.
Yeah, hey, I was just thinking, we've seen pullback in TLT today and everything, and sometimes this market positions are down today.
Sorry, Tony, your audio is scrambled. Do you want to maybe post your question in the chat box? Sorry, it was just coming out pretty. James Robertson, go ahead. Yeah, sorry, Tony. I'm not sure what happened to your audio. It was just really distorted.
Can't get James unmuted. I'm not sure if he actually has a question.
Okay. Yeah, James, if you want to unmute your mic. Yeah.
There's a couple of questions from Mark in the chat box.
Okay. Mark says, aren't all these trades paper products, which ultimately will be worthless when the banks, well, I don't think the banks, I think the little banks collapse. The big banks become more and more powerful. If you think the big banks are going to go under, then you need the little people to go kill all the bankers before that's going to happen. Yeah, you'd need a true Mad Max, crazy. You'd have to literally go kill all the CEOs of all the banks to destroy these big banks. They own the government, they own the central bank, they own most of the stock market, and they own most of the bond market.
Yeah, and all their boards and all their 5% plus shareholders.
Yeah. So yeah, the small banks are being taken out for sure.
Good question though, Mark. Great question.
Mark says, yeah, I do like, so crypto's down a lot, guys. Same reason. I would buy small amount of if I've always recommended a 1 to 2% exposure to Bitcoin and Ethereum. It's the same play as gold and silver. So, and that market cap is so tiny. Just the smallest funds coming in can jack that one up. And that's at like a 50% off sale right now. But that again is no more than 2% of your portfolio should ever be risked in that asset class. But yeah, everything, guys, was just destroyed this week. Stocks, gold, bonds, silver, crypto. The only thing that made money were oddball inverse products like the VIX. And the explanation is, in oil, that's the real key industry that just, yeah, Mark says, so now we're seeing, I think 4 senators are now in quarantine. It'll be interesting to see how well our government can operate with every senator being in self-isolation. Also, Trump shook hands with a bunch of people who are infected. So who knows if he will be. Why is 421?
I heard Trump and Pence saying that they're still going to shake hands because that's what politicians do. I'm just shaking my head and thinking, no, politicians should be leaders and they should set a new tone like they did in Taiwan. They stopped shaking hands and they did an old fashioned, I think it's more of a Chinese tradition, where you put your hands together with one in a fist and the other over wrapping your fist. And you kind of shake it in front of you. And that means like a gratitude or it's like an old Chinese greeting. And so that's what they're doing in Taiwan. And the president of Taiwan, or whatever, prime minister, whatever they call themselves, the leader, was doing that in public, and all the people she was greeting were doing the same thing. And so that is your leaders setting an example, instead of saying, no, this is what we do, so we're not going to change. That just shaking my head. Anyway.
I hope our government doesn't start flopping. Some people speculate that the trade team from China came over with the virus as an attack. So I don't know if that's true or not, but we'll know in 30 days if people start flopping over here.
So when was the trade team here?
So that was back in December. So
December 15th when they signed it.
Yeah.
I'll give you some news, Jason. The Brazilian contingent was here in Miami, and that same press secretary was in that meeting also.
Yep.
Apparently, the mayor now is in quarantine.
Oh God.
I think he actually was diagnosed with it. So yeah.
Yeah.
And of course the guy was up in
very well
Mar-a-Lago.
confirmed by now, but
Yeah.
I have someone very close to me was in that meeting, and she just got notice that she needs to be tested. And lo and behold, I've been around her quite a bit. So.
Oh no, Oscar.
Yeah, well, it's going to be hard to avoid this thing.
Yeah. Yeah, Kathy, let me pull up all the trades we have open right now for the basic membership. And the pro memberships, you guys have one extra call option that these guys don't have.
Jason, did you see the email that I sent? It was an article about China's in their propaganda that they send out. And you'll be familiar with what article or what it is. But anyway, they said that they're going to start withholding, that they might start withholding drugs from the U.S.
Oh yeah, this is exactly. They're going to hold everything. I think the plan is to cripple the U.S. economy. So we got Russia attacking the oil market. We got China collapsing global GDP just easily. All they had to do is shut down their country.
I think the most outrageous thing is the fact that we are unable in this country to products like respirators without congressional approval.
Oh yeah, we can't even sell masks to ourselves. So
you know, that to me, I mean, if just that one concept should just open up the eyes of every American, I don't care what side of the aisle they're on, and say, what in the world were these people thinking for decades that are supposed to be our elected officials? This didn't happen overnight. You know?
Yeah, China's been bribing people for decades in our government.
Yeah,
that's our weakness. That's the weakness of our government and our setup. Tony has a question. With the pullback today of 3% and possibility of a news event over the weekend, Monday could go either way on the TLT. If it goes, yeah, no, I intend to hold these to expiration or once we hit around 180. Tony, because you just got yourself step one. Do you have a stock crash? Okay, let's just review the logic here. Okay, step one, do you think we're in a recessionary period where we have the risk of a stock crash? Well, I think that's pretty obvious, huh? Okay, so what did they do in the last 3 stock crashes? They cut interest rates. Okay, so then what happens to bond yields if they cut rates? So look at the red line and then look at all the treasury products below. Okay, yields go lower, bonds go up. That means TLT goes up. So that's the call here. We got a lot of time on our side. So if we go back to our track record, we have, and plus the next rate decision's on Wednesday. So that's your catalyst for the next big move. But we have, look how much time we have on our side. We only have to sell one of our positions. That was only a risk of $2,036 on next Friday. And once you realize that this is growing exponentially, guarantee you the news flow between now and next Friday is not going to be rainbows and ponies. It's going to be people are dying everywhere.
They just made another announcement here in Central Florida. I just got the alert a second ago.
TLT's acting awkward. I get it. I know people are nervous, but they have a very standard game plan, and I believe it will play out as it always has. So this little yield right here is going to come crashing down as they cut rates. And, you know, the big scare is going to be when they start locking down cities.
I have a question about how much basis points are left and how that affects the 30-year coming down.
Mm-hmm.
Great question, Pat.
Yeah. We only have 50 basis points left.
On the federal fund. So we have 100 basis points to cut to 0.
Yep.
And so,
Right. You're right. Yeah.
Yeah. So
usually it takes 500 to.
Yeah.
Right.
But you got to assume that perhaps there's a exponential effect as you get closer to 0, maybe, hopefully.
Yeah.
But yeah, so now you can start speculating they have to go to negative rates. Let's just look at, you know, what is possible. Okay, so.
While you're pulling up that chart, Dallas has banned any event more than 500. So basically in the Bible Belt, no churches going on.
Well, yeah. Oh, a lot of the really horrific stories are from old ladies going into churches and infecting everyone.
Yeah, Middle
Yeah.
Tennessee, same. Yeah.
Yeah, but for Dallas, the Bible Belt, to basically ban churches, ban church meetings, I don't think you understand how big that is. We still have dry counties in Texas.
Yeah.
Wow.
So, yeah. Okay, I'm used to using my iPad here, but everybody's mad about my sidebars. I'm trying to find my watch list.
The other thing I thought of it with this just 100 basis points is, are people buying the regular Joe buying a bond, moving money into bonds at 0 or negative?
So these bonds cost $1 million a pop.
Yep.
So we only play it with TLT as a retail player.
I see. Okay. Yeah. Okay.
The big banks are, you know, the big hedge funds, big banks managing at least 100 million are going right into the direct product.
Okay. Gotcha.
You know, let me just pull up my iPad here, guys. It's a little easier to use than pull up all my stuff. Let's see. I'm gonna. Share. Okay, it's installing a little plugin here, and then we'll be able to share my iPad, which is a little easier to navigate. Okay, let's see. Does the audio sound good or?
Yeah, sounds good, Jason.
Okay, great. And I think I just need to click off that. You see the iPad?
No, you've got like a screen mirroring option up that's blocking everything.
Okay, let me see. I think I see what to click.
There you
That
go.
good? Okay.
Yeah.
Okay, cool. So I have different watch lists, one of which is specifically to study bond products. And this little chart layout we can pull up. Look at that little print we had. Wow. That was the 180 move. Okay. Sorry. All right. This is the German 30-year. I'm going to try to layer over the American. Sorry, guys. I had this all set up. I stopped using the iPad for a little while. Oops. Okay, so here's the move that's most interesting. And I'm going to go to this is the German 30-year, which having a hard time getting it to compare against the US, but this line right here at 100 is 0. And so you can see for a brief period of time, their 30-year bond went into a negative 50 basis point yield. And so the Germans came in and said they're going to spend an unlimited amount of money to fix the problem and lend as much money as they need. And that gave a rally in their stock market, a little hope in the economy, and pushed their yields up a little bit. But my anticipation is that that their yield is going to soon collapse much lower to fund all these debts. And that'll give the American 30-year product the ability to head towards zero and maybe even into negative territory. So it's all going to be relative, by my best estimate, to the German 30-year treasury. The lower that goes, the more we can the lower we can speculate that the US 30-year yield can travel to. So last year we saw it just fall off a cliff, and they've come in with massive stimulus, QE, but I believe they will have to cut rates aggressively as the next big move. And I believe that'll be what all central banks have to do. So if we pull up the yield curve on our 30-year product, let's go back to that. We can see the potential for this to go at least to, I think at a minimum, we can see this hit that the 2-year is currently. So the 2-year has been acting. Does my audio still pick up well and visual?
Yeah.
Okay, good. So the German went to negative 50 on the 30-year last year during the peak of the trade war. And they've come in with some QE and said they're going to do unlimited In fact, all the countries their first response this week has been QE to try to save their stock markets and their and that did give us a little yield pump this week. But I do believe the next big move is they're going to go into rate cuts. So if we just track the 30-year bond from the Germans, that'll give us a good heads up as to just how far our 30-year yield could potentially fall. The 2-year I'm looking at as has been a good leading indicator of what the Fed will do. So that's not indicating a 100 basis point cut yet. But I think that's just because we had so much massive selling that all of the because of all the bankruptcies, people had to liquidate everything. So I think that's giving us a lot of noise that we need to read through. My expectation is this entire part of the dot plot will be at zero in very short order, and that these are going to come down with it. So if we see this drop anywhere near 1 or 0.5, that's a massive, massive rally in the TLT. We were calculating this yesterday, but I believe getting to 0.5 would be around a 35% return on the TLT. So yeah, that's as far as getting a little scared in the short term without seeing other central banks go into severe negative territory, which I do believe they will have to do. Because think about it, if we have negative GDP, that's what would cause them to go into negative interest rates and use fiscal stimulus to try to keep the economy running. So that'll probably be our first bounce, would be somewhere between 1 and 0.5 on the 30-year. So that does give us a substantial move to take advantage of here. In terms of what that is price-wise, so the high we've seen was 179. I think it was 180 for like a split second. But if we were to appreciate by 35% from here, that would push us up to 207. So that's the type of move I see in the first leg of this rally in the bond market, then probably a pullback, and then we're going to need to push into negative territory because the underlying problem that's unraveling, I expect to take no less than 2 years to really solve. And think about it, there's no vaccine. Yeah. Jerry says there's very little test. Yeah, they're blocking the testing. It's ridiculous. Oh, Jerry says the virus has not done much in the last few days. Yeah, because they're not testing. There's a big scandal. The test kits that came out didn't work. Then Pence came out last Friday and promised us we'd have 1 million kits. And they've done all of like 77 tests. So now people are trying to get their hands on their own test kits outside of the CDC. So that is a huge, massive scandal. And obviously they're just, if you want to have Jerry says the John Hopkins site, I think they are owned, I think they're very large benefactors of interests who trying to keep everybody calm and underreport. But yeah, I don't think this data is anywhere near accurate. But even if you take what they're giving you, it's growing at an exponential rate. And so let's just find that CDC website. Yeah, CDC seems to be highly corrupt, unfortunately.
So Jason, to what end does the delayed and restricted testing get to? Because I saw it as up front, they had only tested, 445 before the president went on TV. So that to me felt like, okay, well, they have delayed so that he could, they had time to get in front of it and make an announcement, but they're still continuing to delay. So there's got to be a reason. And there's still more to their reason, right?
Yeah. Yeah, they must be trying to delay so they can prepare. But you got to realize the longer they don't test and tell people the truth, the worse the situation is going to become. And yeah, this is just retarded. This health official in Ohio thinks they have 100,000 cases just in Ohio. So why wouldn't you test? Well, you wouldn't test if you knew everyone has it. Okay, you're just going to create panic. You're going to kill your economy. So this is going to be a fine balance of trying to keep your economy running and not overburdening your healthcare system. And unfortunately, it's going to be this, they're going to have to put the brake pedal on and then put the gas back on and then put the brake pedal back on. And then it's going to be back and forth for probably no less than at least 2 years. Now, sure, I hope we get a vaccine in 14 months, but SARS doesn't have a vaccine 17 years later. So why in the hell do you think you're going to have one in 14 months? Maybe because we're going to throw all the money that the United States can scrounge up through its bond market at the bio. Yeah, so yeah, exactly. Mark says they're delaying until they figured out how to reset. I think they already have a plan, and that's let the stock market crash, raise money from the government, cut rates, reward the bond investors, solve the underlying problem through government intervention, which is going to be to bail out key industries that support a lot of labor and to hand trillions of dollars to healthcare companies. Okay, after that is underway, the budget's been raised, the plans are rolling out, the stock market has crashed, then they can stop raising so much money through the bond market and start pumping back the stock market. But they got to fix underlying problem first. And so, China's been lying out their ass about this since November. Russia's creating an oil war, connect the dots. So my expectation, rate cuts to zero, bond market takes off. After that, or leading into that, we start to see some push in gold. But again, bond market first, and then gold market second is where I think we're going to have opportunity here.
You still have a question, Tony? Your mic's working now, Tony, if you still have a question.
Yeah, I was just wondering on the with this rate decision coming out, you have a figure. You think that I know the TLT has been to 180 recently. With that momentum now it's pulled back so much, is the negative momentum going to hurt that target?
No, I think the banks are going to buy bonds because they know the Fed's going to cut rates and then do QE. So it's a no risk deal for banks. Let's see how low we got. So we hit 180 by dropping 50 basis points for a day. Okay, then we had everybody go bankrupt this week and liquidate everything, and we've gone up 66 basis points. So you come in with a 100 basis point cut next week, I bet you we're back at that 180 level pretty quick. But retail doesn't buy bonds. You got to realize retail. When's the last time you heard somebody on CNBC tell you to buy a 30-year treasury? When's the last time you saw the president talk about loading up on some bonds, huh? No, no one tells you to buy bonds. They tell you to buy stocks. So bonds are for the banks. I mean, the minimum purchase is $1 million a pop. So yeah, I highly confident the banks are going to buy bonds from the government. The government's going to just think about it. If we don't do this, what happens to America and the whole financial system? Okay, airlines are going bust. Half the industries are going to go bust. Okay, the banks don't have enough money to bail out everyone. So it can't work that way. The way it has to work is the government has to issue bonds. Everybody has to buy them. Everybody buy them has to make money. They can force that through this right here, the federal funds rate. This is the only path that works. They must raise capital through the government, use the government to bail out key industries. They're going to be bailing out everybody. Consumers, they're going to be bailing out airliners. They're going to be bailing out. I think they're going to let the small banks just go because remember, it's the big banks that control the Federal Reserve. It's the big banks who get all of their, top employees to go have a seat in the Treasury and all of the government spots. So this exact pattern is going to happen. They're going to cut rates and then they do massive QE and everybody bought the bonds makes good money. Once the underlying problems resolved by the government bailing out people. So in the dot-com bubble, we had to bail out IPOs. In the 2008 crisis, well, the banks got greedy loaning mortgages. People didn't have enough income to pay for them. This time around, there's a lot to bail. I mean, we got to bail out just about everything right now. So yeah, now you got to bail out everything, and these rate cuts could go below zero. I think we're going to go to zero next week, and then potentially into negative territory from there, because this is just something that doesn't go away. Now, maybe the strategy is to just try to let it ravage through society as fast as possible. But the problem with that is you're going to have too many people overburdening the hospital system. So my expectation was to see cases by the 7th and deaths by the 15th. Okay, I've been telling everybody that for quite some time. Only thing I was wrong about was that it's happening much faster, which means this virus has been here a lot longer than I thought. So we got deaths before March, and now we got a lot of deaths, and it's growing rapidly. So they're blocking the testing. Meanwhile, Tom Hanks has it. Basketball players have it. Soccer players have it. Our government officials probably have it. So, this is going to get worse before it gets better. This is the tip of the iceberg.
Jason, we're seeing significant activity.
You're seeing the flow?
Mm-hmm.
Yeah.
Yeah, Jason, this just came out too. So Italy death toll from coronavirus outbreaks rises to 1,266 from 1,016. That's day-to-day numbers.
Oh. Yeah. So the big panic's not here. This is, you just got the first raindrops sprinkling on you. So I suggest you get your umbrella and find shelter. That's what I think's coming. And every day I wake up, I was never a virus person, okay? I never thought in the wildest dreams I'd be studying the coronavirus for 12 hours a day since about middle of January. But when the Chinese stock market crashed and they suddenly bowed over to this trade deal, when they should have been having their stock market rocket, and then they underreported the seriousness of this. They kicked all the journalists out. They're trying to tell us 3,000 deaths in China, but yet they're welding people shut in apartment complexes. No, it doesn't add up. 3,000 deaths.
We've got the mass graves in Iran too now.
Oh yeah, it's this whatever this is, it's deadly. It doesn't just kill old people, and people are going to start plopping like flies. That's what's rolling out in the next 2 weeks, and that's when you get your big crash in the stock. I mean, this is nothing. Look at this. We're not even. This is nothing. Okay, so you got to realize stock market up here was worth, I think it got up to, anybody know the highest value? Look at that. That's just a few weeks ago.
339 on SpyJ.
Yeah, so I think that was something like $32 trillion market cap. Well, the Fed only has $4.5 trillion in its balance sheet, which represents, how many dollars primarily are available. So if the Fed doubled their entire balance sheet, which would just crush the dollar, they could only afford to buy 10% of the stock market, or 12. So the central banks can absorb 1% sell off in the market cap for a couple days, about 300 billion a day. They can do that. But when you get 2 or 3% of market cap selling at once, and then you got Chinese sitting there every time we have a rally, they're bidding it up, trying to trick everybody into buying it. Every time we have a little sell off, they're selling as hard as they can. They can't handle trillions of dollars without destroying the sovereignty of the dollar. So I think that's what this is really about, is trying to take down the dollar. And they've been talking about wanting to take down the dollar for decades. So that's no surprise. You got Russia doing an oil war right when we have a financial crisis. We got Chinese lying out their teeth about this virus. They knew about it since November. They put the people who were the doctors in jail who are trying to warn everybody. And then they've been lying about it ever since. Now they're trying to blame it on us through their propaganda arm. So yeah, we'll see. Do we have some traders here in the United States? I guarantee it. Okay, that's the biggest thing about such an open government, is that people can be bribed easily. In fact, for the last 2 decades, we're inviting China to come buy up everything, send their students here. So my expectation is, first, we got to solve the problems at home. We got to take care of this huge explosion. I'd expect 10 times the hospital flow within the next 2 weeks. Within the next 30 to 60 days, probably 100-time fold. Hospital system now can't even handle a 20% increase in flow. 90% of our hospital system's already occupied. And the bigger problem is that if you take these coronavirus people into the hospital, you're just going to get everybody sick, because it is almost without question airborne. So it's got about 10 feet radius just from people breathing. So the big panic's not here. And, you know, I was the guy who didn't wash my hands and ate food off the ground 3 months ago. So I'm not some kind of virus paranoia guy. I've been watching this unfold, been warning everybody stock market would crash from the very, very top. Looked like an idiot because it kept going up, and boom. Sometimes this is a once in a century move that's underway, and I believe we're about 1/3 of the way.
Do you have another question, Tony?
Yeah, I typed it in chat.
Oh, okay.
Let me check it out. Mark says banks lose $1 billion for every dollar silver rises. I didn't know about that. Where would the TLT be with a 100 basis point interest rate cut? Oh, yeah. Uh-oh, Tony's getting those greed glands going. I like it. So yeah, so once again, let's just remember the way so let me pull up this really quick. So a lot of people are trying to say that the 2-year screen one has been telling the Fed what to do. Okay. But it's really predicting what the Fed will do. Okay. Because there's plenty of times in history where the bond market it's just wrong. It predicts something that doesn't happen. So yeah, the big risk for us would be that they don't cut rates. Okay. Now, chances of that, I believe, are slim to none. Otherwise, I wouldn't be so aggressively playing this trade. Okay, so what we're really interested in is not necessarily the 100 basis point cut, but what the bond market predicts the future cuts will be. And so we saw him predicting a pretty large cut right here. And this is when we had those 9.5% down day this week, blew out people. We had oil market crash. So the only explanation for that bounce right here is that people had to sell everything. Okay. Also, central banks know that they want to get their insiders out of the stock market. So they will sit there and sell bonds, sell gold, and pump up stocks with every little offshore account they can. That's funny money, central bank money, so that the insiders can sell stocks as much as they can. They want to get as much money out as they can. Okay, so my expectation is this is going to crater here. But yeah, let's look at the move we caught. So the recent move to get to, the 30-year goes to 0.99. We're looking at that 179 TLT. And I think that'll probably be the next spot we find the 30-year where I want to take some profits. Now, I do believe we will go further than that, because to understand why we would go lower, we have to start to calculate what is it going to cost to deal with this economic slowdown. And I'm telling you, it's going to cost trillions of dollars. So the government's going to have to take these auctions, which are pretty small right now. I mean, these are already huge deficits we're creating. These are going to have to start doubling, tripling, quadrupling. You tell me, how do you go sell extra $100, $200 billion of debt if you're only paying 1.5? And if that yield were to rise, you would be stuck making 1.5 for 30 years. Look at this. If I went and bought $1 million worth of this 1.5 30-year, I'm stuck making 1.5 for 30 years unless the yield goes down. Then I can flip it for a profit. So who's going to buy that 1.5 30-year if they thought that yields were going up? Nobody. Everybody just wait for the yield to go way higher. You know, what yield would you actually commit to invest in a 30-year USA bond? Probably if you thought they just would not cut rates. Now, why wouldn't they cut rates? Well, inflation, if they thought there's too much inflation. But I think they're going to have to look the other way, because there's obviously going to be inflation, because the cost of labor is going to go up because everybody's scared of getting sick. So they're going to have to let inflation run hot. They're going to have to cut these rates. So what do I think is the big picture here? We cut rates. We raise a lot of money at the government level. We bail out consumers. We bail out airliners. We bail out oil companies. And then we hand healthcare trillions of dollars. We push rates to zero. We allow the stock market to collapse. That thing can bubble back up quite easily, especially once we've expanded the money supply dramatically during this period. We keep our economy alive. So 18% GDP in healthcare is probably gonna go up to 50 or 60. So that's where all your profitable companies will most likely reside. Okay, then what do? All right, we deal with this crisis and then we strike back. We strike back at China, we strike back at Russia. Now, how do we do that? We're gonna sanction all their companies. We're gonna get all our allies to ban Huawei, ZTE. And then the big move, here's how you crush your enemies as the United States. Okay. They're gonna hike interest rates up. And that will blow out all of their financial instruments. So that's what I see as we're going to go to zero, maybe to negative. We're going to resolve the underlying problem. We're going to raise trillions of dollars at the government level, bail out everybody who needs to be bailed out. We're going to survive this attack. And then our biggest weapon is to raise rates, but we have to heal our country first. So if you go back,
that healing is going to need to include onshoring critical type of goods and
oh
stuff.
yeah,
that
we're going to
are
move
made in China.
all manufacturing's coming back. Yeah. So yeah, I get it, guys. We got a little, we got a little volatility on our TLT, but when you get the big picture, I don't see any other way out of this. If anybody sees another way to solve all your airliners, oil companies, and healthcare system going under, and millions of people getting sick who can't afford healthcare, tell me how you're going to solve that. Because the only way I see is the government borrows money and bails everybody out. Then they have to make it attractive for investment, so they cut rates, and that's why they've done that. Look at every single recession. You could go back for an entire century of U.S. history, and every single time there's GDP slowdown or a recession, rate cut, rate cut, rate cut, rate cut. They did a little late in this one, but remember, we're fighting runaway inflation in the 70s. Rate cut, rate cut, rate cut, rate cut, rate cut. So yeah, I don't see why they would not do rate cuts this time. And if they do, we're positioned perfectly.
A couple questions in the chat from Scotty, JC, and Mark.
Okay, good. Let me pull that up. Scotty says, if the SPY is only 1/3 of the way down, why not the invert? So instead of doing the SPY trade, I'm doing the TLT because it's safer bet in my judgment. Imagine we done the inverted collar yesterday and we have this 5% pop in the futures market. Also, Scotty, if someone screws up that trade, because yeah, I've been teaching everybody the inverted option collar. If anybody screws that up, and our audience is new to a lot of this, they could lose a fortune. So I decided the better bet is TLT call options. It's just a safer way to make the same prediction. And also, because I understand the way, the SPY could do whatever it wants, that TLT is going to go up just because of rate cuts. JC says, where will the profitable companies reside? So yeah, I have 3 ETFs, all healthcare related. So healthcare, biotech, medical supplies. Okay. I think the timing on that is just right. Once they start talking about massive spending bills, that's the time to get into those 3 ETFs. So far, 8 billion is what they've approved. That's a joke. We gotta raise through the bond market trillions of dollars to just for the healthcare industry alone, not to mention airliners, not to mention oil companies, not to mention all, imagine every company in the United States that's going to suffer from people being scared to go out.
I can't think of a company that won't suffer.
Yeah.
Except for portfolio builder.
Yeah, everybody working from home.
Amen.
Yeah. So yeah, I don't like the little pullback we have in TLT. It's not getting crushed, guys. It's Perry.
Hey, Jason.
Hey, Perry, how's it going?
Going good. What kind of chance do we have of them actually shutting down the market?
So that's what I would do if I was president. I don't know how you do it. I would shut it down for 90 to 180 days.
Yeah.
So I hope they do that for America's sake and protect all the retirement accounts because people are just getting killed. But so far they're saying they want to keep it running. I don't think that would affect our trading plan though, in terms of being long the bonds.
Okay.
And they need to raise money through the bond market. So even if they shut down the stock market, I don't think they'd shut down the bond market. But yeah, I wish they would do that because people are just going to lose fortunes here if I'm right.
Well, in China, if the numbers were right a while ago, with Italy having already over, I think it was 1,200 deaths. I mean, that's just been in a couple of weeks. I think China's numbers are going to come back. They're going to show that they've been withholding information, I think, pretty soon.
Yeah, whatever it is China's done, even if China had no deaths and no coronavirus, just the simple fact that they shut down the economy for the better part of 2 months, that alone is going to create a global GDP shock that would push rates lower. Just the fact that they shut down because they're the second largest economy and they basically put everything at zero for about 45 days. So just that alone is massive, massive impact. Much less causing every country to shut down like dominoes. So first we saw Hong Kong. Now Hong Kong had to survive SARS. They know all about the evil Chinese Communist Party. So Hong Kong was able to lock down very quickly and apparently cope quite well. It looks like they're already back protesting, which is interesting. That is very interesting to say the least. Then we saw South Korea have to go to lockdown. Now Italy's on lockdown. We had our first death in India. The Americans won't even test their own people because it's everywhere. So that would just cause panic. James Robertson.
Do you have a question, James?
No, I don't have a question. I'm sorry.
Oh, no problem.
Oh, no worries.
We got some messages from Anwar in the chat, but I'm pretty sure you've gone over that several times.
Anwar, did you buy the put option to protect your GDX yesterday?
No, I didn't. Can you hear me?
Yes. So how come you're not following the program?
I don't know, because I'm deep in the red, and I did what you said the other day. I sold all Baba and all Microsoft.
Okay,
and
well, let's
took a big
review.
loss.
Yeah, but we told you to sell it a week ago, right?
Say that again.
So yeah, we've been telling you to sell that for over a week now, but
I know, but it's hard. It's easy maybe for you to say, but when you lose 100 grand in a minute,
yeah. No, I feel you. I feel this is not a good time for most people. Well, yeah, let's just review what the instructions were yesterday, even though it's normally for pro, just so we're not confused here.
And one thing I have to say to Anwar is when I have an open position and I see its current active loss amount, even though it's open, to me, that is the loss I've already taken. Not that's the loss if I close, that is what I've already hit. And so I mentally realize it immediately rather than mentally realizing it when it closes. Even though, you know, accounting wise, you don't realize it till you close it.
that's right. Yeah, but
I'm going to go ahead and review the pro
Okay,
program,
let's-
even though we
yeah.
don't normally,
Okay.
and make sure we all understand how to do this if you're in the pro.
Alright.
Because, okay, so first of all, we didn't recommend yesterday to just buy GDX. It was to buy the put option to protect it. So we doubled the exposure to GDX, but we bought the married put. So the strike was $23 and the cost was $232 for insurance. And so that insurance is paying off very well right now.
Okay, so you buy a put.
So yeah, so let's just go through, let's just read the entire instructions for pro yesterday.
Mhm.
Okay, so first of all, for every $100,000 following the program, we recommended one $170 TLT call option, which you can get today at a discount compared to what's reported in my track record. That was step one. Step two is get half of your assets into cash, which means no equities. So you followed that. Step three is to get 40% of your assets into the TLT. That you have not done. The next step was to increase GDX so you have 2 times as many shares of GDX as TLT. However, you bought the 5-15-23 put. So this is called a married put. So we had to pay, here's the trade. We had to pay $232 to protect $2,300 worth of equity. So the second we bought that, this is called the in the money put. So you can see it's trading at 22,881.
So again, GDX, you buy a put again to protect it, or you sell a put?
We bought the put. So the ask, if it's the ask price, that indicates buy. We put option purchase today. Also, it says buy to open. It says for every, so it's really important to get the same results as I do, is to follow the trade alert. So it says for every 100 shares of GDX,
Yeah.
buy to open the 5/15/2020 $23 put. Okay, so right now GDX is down, but guess what? We own the $23 put. So that means we get $23 no matter what. Now, what's the catch? You know, it can't be just, you know, every investment comes at a cost. So we bought the GDX when it was trading at 22.18. It was down 10% that day. Okay, so I knew the downward momentum when I told you guys to double exposure was down, right? It was down 10%. It's not a normal move. So the instructions were to buy the shares, but to protect with the put. So if I spend $2,281 to buy 100 shares of GDX, and then I go invest $232 for the 23 strike, that's essentially saying, okay, I will pay 10% of the value of these shares for insurance to protect my position through the next 64 days. Okay, so what does this really equate to? I took a 10% loss to enter the position, and I can't lose a penny more than that. My hope is that by the end of this expiration, which is 64 days away, see the 64 right here?
Mhm.
So I bought 64 days of insurance for 10% of the value of the asset. Okay, so this says whoever sold me that put is agreeing to buy my shares for $23 a share. And all he wants to agree to do that, no matter how low GDX goes, he wants $2.32 a share to take that risk. So my hope is obviously that this will go up. The hope for both of us in this case. So the guy who sold the put and myself, we both want the same thing. Okay, he wants to keep the $2.32, $232. Okay, and the only way he keeps that is if the underlying asset goes up. So he's really hoping that goes back up, because if not, if this goes to 20, which is where it's at right now, right? 2077. If I were to sell my put option right now, even though the shares are only worth 20, he has to pay me 23. That's the option contract we bought. So how do we make money if we're paying $2.32 per share for downside protection? Well, we need it to go up more than $2.32. So we basically agreed to a 10% loss upon opening the position with 12% of our total capital. So I can lose between now and the next 2 months, I cannot lose more than 1.2% of my total portfolio. To make money, I'll break even once this goes up $2.32. So I need this to go above 25 to start making profit. If it goes to 25, we break even. If it goes lower, all we lose is the cost of our insurance. So it's called the married put. It's a very good strategy to buy a product that is selling off, which you believe is oversold, but might have some more momentum going against you. And so when we bought this note, GDX was ferociously selling off. It was down 9% when we bought that. So does that make sense how we are playing the gold miner?
Yeah, a little bit.
When did you buy that, Jason?
This was yesterday's trade alert that we're looking at.
Yeah, I'm not talking about the puts. I'm talking about the actual shares themselves of GDX.
Trade alert yesterday was to double from a 1-to-1 ratio to 2-to-1. So we doubled our exposure and applied the put yesterday.
So you bought positions.
And
We've
these
had-
are our pro only trades, everybody, not our Monday, Wednesday, Friday trades.
No, but you bought the stock and the puts?
We've had GDX for 15 months.
Yeah, I bought into it in February 25th, but I paid $31 a share for it. So I was just questioning, where you got the 23 from. So
Yeah, right here in the screenshot.
yeah, I see that, but I was asking when that happened.
This was, are you in the pro membership?
Yeah.
Okay, so yeah, this is yesterday's trade alert.
Okay. So you bought positions, you bought stock, and you bought puts to cover it. Is what you're saying.
Okay, let's read the trade alert.
I was out running around yesterday and I read that and I didn't quite understand it. So,
Okay, so here's what it says. Increase GDX position to a 2-to-1 GDX TLT ratio. And for every 100 shares of GDX, buy to open one May 15th, $23 GDX put option.
mhm.
So we doubled our exposure. Previously, we had a 1-to-1 ratio of GDX to TLT.
Hmm.
Jason, I think he's talking about, I was getting ready to ask the same question. You know, we had 400, or I did, I had 400 shares going in. I bought those 400 shares a number of months ago.
Right.
And they were at a higher price. These puts that you're talking about protecting the GDX are only going to protect, well, I bought 8. So I bought 400 more GDX and then I bought 8 puts.
Sure. So in my track record, we have a entry at 29.81 for the first 3,800 shares. And then we bought a additional 3,800 shares yesterday at 22.81.
Right.
And at that point in time, we applied the put option, which I need to enter in here, which is this trade that we're looking at. So we doubled our exposure to GDX, but we applied protection to all of our shares.
But your price per share now is about what, $26 plus $26.
For every 100 shares, if you're following the instructions, for every 100 shares of GDX that you own, you should have one put option from yesterday. And
I do have.
Okay, then good. You're following the instructions.
Well, I was just saying that the figures you're giving, you're saying that you know, you're not going to lose anything, but our average cost for GDX is $26 a share.
Right.
So what I'm saying is from the point here. So yeah, most of you guys bought GDX at a higher price point.
Yeah.
Okay.
Well, I bought it at $29, just like that fella did.
Sure. Okay, so yesterday I told you to double your exposure. I told you to buy more and to protect it with a put that was in the money.
Well, that was confusing part for me. When I read it, I didn't understand you wanted us to buy more shares and buy puts to cover all of them. Because I already had 400 shares of GDX that I paid quite a bit more for. And then you're saying to buy 400 more plus buy 800 puts.
8 puts.
Or 8 puts, I mean. Yeah.
Yeah.
That wasn't very clear. To me it wasn't anyways.
Oh, I thought, yeah, it was clear.
Okay, well, yeah, I'm sorry. I'm not sure what could I do to make it more clear next time?
I don't know. I guess, we already had positions in GDX and, you talk about increasing your position to GDX. Again, I guess I assumed it all together, rolled it into one about buying the puts, not buying the, position and also buying puts. I guess that was my error. So I don't know how you can make it clearer, except for I misunderstood it. So.
Hey, Jason, this is Rakesh here. Can you hear me?
Yeah.
Maybe what you can do instead of in your communication, use tables rather than text that you have. And hopefully that will be a bit more clear so that people don't misunderstand your direction.
That's a good idea. Any other?
And if you want, I can actually draft a simple table and send it to you. That's not a problem.
Sure. Yeah. Appreciate all the tips and.
Yeah, because I would agree with the other person who was speaking. Sometimes the communication, you wonder, what are you really saying, right? Because you know more, and hence some of the jargon that you use, a person like myself, and maybe there are others on the phone as well, would not understand basically what you're saying.
Okay. Well, is there anything about the language that doesn't make sense on the screen? Just so that at least, because most people did understand. That says increase GDX position to a 2-to-1 ratio. And for every 100 shares of GDX, buy to open 1 May 15th, 23 GDX put. Is there anything about that that doesn't make sense to anybody, at least now that we've spoke about it?
I mean,
Ask, what is your expectation on GDX? Do you expect it to go down? So if we buy a put, so we will not make money unless it goes up.
Correct. Yeah, we want it to go up more than the cost of the put in 60 days.
right.
So you expect GDX to go up, so our put will cover it. I already lost $6 on every share, and I bought 2,000. Am I there or not?
Oh, yeah, I hear you.
Hey, I'd like to make a comment about that. I think what Jason is expecting is GDX to go up, but in case it doesn't, he's got to put there to protect against downside losses or large downside losses. But the expectation is it to go up more than the cost of the put. But the put is just the insurance in case he's wrong.
Yeah, so this is a popular strategy. It's called a married put. So once again, what was happening to gold when we bought it yesterday, guys? It was selling off at rapid pace. It was down 10%. So what's the momentum of gold yesterday? Up or down?
Down, right?
Down. Okay, so if the momentum's down, what's probably the short term, you know, what do you think is going to happen in the short term? If something's falling, do you think it's going to keep falling? Probably, right? So I told you to double down because it was at a value, but I knew it could keep going lower, so we bought a put. So that'll be our strategy anytime we're buying an asset that's falling. And especially with a tiny market cap like gold. So that it's called the married put. And basically, if it goes below 23, the most we lose is the put value. From here, I understand you guys bought shares earlier. We didn't have put protection several weeks ago. Okay. So today or yesterday, the market was crashing. People were liquidating all assets regardless of what they were. So that looks like a good opportunity to increase exposure to an asset class we think is going to do very well in the coming year, which is due to all the banks printing money. But again, the momentum was not up, it was down, right? It was down 9%. That's not normal. So the trade alert said, double your exposure, but buy protection for the entire position. Now, do I wish we'd done this when it was up at 29? Yeah, of course. But remember, this is this was less than 10% of our portfolio. Okay, also, this is the portion of the portfolio that has outperformed all other sectors, and it's had to have volatility, guys. This is the smallest market cap. So we had a 73% return with 10% of our assets in this portfolio last year. Okay, so this is a risky sector, and that's why we use less capital. And it's had plenty of double-digit swings. Okay, you're not going to catch the big run-ups in gold without the right strategy. And the right strategy is you have to be exposed to the risk. So you got to have small exposure. Yeah, so what should you do? Go ahead, Tom.
Tom J. Hey, let's say if one were going to make that purchase today, what?
I'd
price would-
I'd buy the 21 strike put with the same expiration today.
Okay, so you wouldn't be any worse off, particularly. Well, you might. Okay.
Yeah, so the bet is really simple with this. We're gonna buy the strike right above the trading price, and that locks in your loss at that moment in time. So my loss was locked in yesterday, at least for this time period, at the cost of the put.
Okay, thanks.
And I want the asset within 64 days. So I want the asset within 64 days to go up more than the cost of the put to get a profit. And again, the precious metals is a volatile asset. That's why we use a lot less capital. And it has had our best returns by far. It's also had the most volatility by far. So you have to play this asset class with a lot more risk. That's why I would never go up more than the risk profile we have. And yesterday and this week, companies getting blown out. They're liquidating everything. So it's a fire sale. So long run, where do I think GDX is going? Let's just take a look at, let's look at the potential for GDX for all you guys worried about it, okay? Now, again, if you're using the right amount and have that put, you can lose no more than 1% of your total assets in the next 60 days. But here's why we're buying GDX. Okay, so everybody wants to point out that, again, 2008 GDX sold off, 2009 went up. Okay, 2008 we did rate cuts, 2009 we did quantitative easing. This time around, we're already doing QE, okay? So how do we know we're doing QE? So this is federalreserve.gov, H41 release. This is their balance sheet. They update it every Thursday. Okay, you can click on that bad boy. Just focus on this in terms of balance sheet growth. They increased the balance sheet by $75 billion. Next week, I think that'll be significantly larger. We're probably going to be adding $250 billion to the balance sheet weekly. So that's when you want to own gold products, is when they do QE. So we went from 21, 2009 to a high of 66. Okay, that QE that we did for that period of time grew the balance sheet to about $4.5 trillion. They tried to pull it back a little bit, and that's when you got your gold crush. So yeah, I will continue to hold that position for the next several years because we're going to have to print a lot of money. Are we going to have a little volatility? Sure. But if we're doing quantitative easing at a global level for a prolonged period of time, I want to have exposure to gold and gold miners in this case.
Hey, Jason, Scotty here.
Hey, Scotty.
I definitely understand getting used to the trade alerts, but I've been a pro member since September, and I did execute the trade alert just as it was stated. And just to give context for what this means to my portfolio, I have 75K, and the only reason I disclose that, that's small compared to most people, but that's the entry point that you recommend for being a pro member, so we can have the right allocation.
Yep.
I have the allocation today versus yesterday on the alert. per one put or per 100 shares that I own. GDX is down $139, but my put protection is up $116. So net, I'm down $23 per 100 of the ETF or per one of the put options. And just to give you a sense of where I am with that 75K per my correct allocation of this, I'm down $69 total. So $69 against a $75,000 personal balance that I'm managing. It's peanuts. So, and this is just one day. I mean, who knows what it's going to do in the future? We're positioned for this in the long term. So I'm perfectly happy with the position I have on, and the $69 for the day is just, you know, one day volatility.
Anwar says, what would you think if I sell? So, okay, let's talk about this. Thank you, Scotty. That was very
thanks,
good.
Scott.
Very good. And yeah, I think it's critical that you follow the plan. People seem to be kind of picking and choosing random pieces of it instead of following the real plan. So Anwar, if you sell a put, that's the exact strategy that caused people to go bankrupt this week. So I wouldn't recommend selling puts. One, two, the opportunity here is to own the equity and allow it to appreciate with a similar move that we saw from 2009 to 2010. So my best suggestion is follow the trade alert and don't worry about it too much. Let time work its magic. The only thing that you want to know for a fact to be long gold is if the Fed's increasing its balance sheet. And I could tell you it's increasing its balance sheet. So what you want to do is protect the downside volatility with puts and be long the equity. It's called a married put. And we'll be using that on GDX until it starts behaving appropriately. Yeah, so, yep. So yeah, this is an asset that can appreciate very quickly. And you can look at, we're on a monthly chart. So this is popping up. Once the QE really worked its way into the economy, and we saw it pop in 1 month periods, we saw it pop from 21 to 26 to 33. That's at the start of the QE period. So our bet is that we can get GDX in a period of 2 months to go more than $2.30. So let's see how much it went from this period. It went from $20. So we have 2 months in this bet. So when they started QE in 2009, because of a small mortgage crisis, GDX went from 21 to 33. So we would have given up $2.30 of an $11 move. That's the kind of investment I want to make. So the only way to do that is, again, to, because you got to realize we're buying it into, we're buying something like this chart right here on GDX. So we know there's downside risk. The momentum is it's falling. So if you want to buy something that's falling like a rock, you buy the put option below it, and you hope that you're near the bottom where it's going to rally right back up. Okay, so this is exactly where we're at. Rate cuts just happened. I think there's going to be, this is odd time because there's rate cuts and QE. Okay. So we're buying into something like this, knowing full well there's the momentum is down. So we buy the asset, we protect with a put. We have 2 months of time premium in that trade. We want the asset to go up more than $2.30. Okay, that's it. That's all there is to that trade. So I like the trade better today than I did yesterday. I would do the same recommendation. Buy a put. If you want to be a cheapo, go $1 or $2 below the trading price. If you want to get the least risk, then go right at the money. You're going to realize your maximum loss by applying the put, and then you sit back for 2 months and you hope it just jumps up like it did the last time we did QE. And I'll tell you what, the QE we're doing in the next 2 months will be dramatically larger. I mean, 10 times the size of what happened in 2009. So I'm not worried about any of our positions because this is all stuff that's central. You know, we're not worrying about whether Apple's going to sell an iPhone. We're just trying to predict what is the central bank going to do to deal with the crisis and what's the government going to do. Okay, so the government has to bail out all the industries that are failing. They have to do that through the bond market. So the Fed has to cut rates. But at the same time, both our bond market and stock market are being stressed. So they are now doing quantitative easing and rate cuts at the same time. So that's a perfect recipe for bonds and for gold. Okay, so why the hell do we have a sell-off? That's what everybody wants to know. So if I'm right, if all the fundamentals make sense, why on earth did we sell off? Well, the market cap in gold miners is tiny. Okay, so it does not take a whole lot of selling to create a move like this. But the fundamentals of owning gold miners right now are better than they've been in a century. Oil's cheap, spot gold is high, huge profit margins, and we're going into a period of massive, massive money printing, not just in the States, but worldwide. So I like buying gold miners with a married put. And once we start to see this react in the right way, I might get a little cheaper with my downside protection. I was expecting, obviously, when we were getting here, that this was the beginning of a move just like this. Okay, so we're a little early. We had a bunch of people who were selling puts in the stock market and the oil market get wiped out, and they've had to consolidate everything in their portfolio regardless. So you saw everything sell off this week. Stocks, bonds, cryptocurrencies. I mean, it's a bloodbath everywhere. Stock market's the biggest bloodbath, but all of the other associated micro markets are getting trashed as well. So once the complete liquidation is over and the losses have been absorbed, then the money's going to come start buying the smart assets. All right, guys. Any more questions?
I have a question. You kind of covered this before. So one of the things that I keep hearing over and over, and just hearing it actually makes me nervous, that, and they showed a clip of Trump meeting with the big bankers, and then the Canadian Prime Minister basically had the same message. Our banks are well funded. Our banks are in great shape. Reminds me of, right before there's corporate layoffs, the executives always say, look, we're doing okay. There's not a problem. Company's going to be fine. 2 weeks later, there's layoffs.
Yeah.
Feels like that. And you've kind of been talking about it that, okay, maybe they do have enough money, but if everybody needs a bailout and everybody starts, exercising their revolvers and going after the cash, which is going to be like a modern day version of a bank run in a way, that'll wipe them out. Right?
I think the small banks are going to get wiped out, and weak companies will get wiped out. But yeah, this will be a survival of the fittest episode for the private sector for sure. So anybody who is over leveraged, living on debt, think of all the tech companies that rely on selling bonds to operate, like Netflix, Uber, WeWork. Yeah, so a lot of people can get wiped out here. So that's what I see is a massive stock crash because it's private sector that's getting hurt. Government must bail private sector out to keep the job market healthy. And that means they have to sell a lot of bonds coming up. But yeah, we haven't even gone into lockdown yet. Imagine when healthcare systems completely overrun. LA, Washington State, New York City go to lockdown. Schools continue to be closed. We start getting actual economic data for Q1, goes negative. Forward guidance starts getting negative from the corporations. China starts halting supply chains. This can get very, very nasty very quickly. Yeah, the tech executive has been selling for quite some time. I'm not saying they knew what was coming at us. I don't think anybody saw this coming from a mile away. Jeff says the John Hopkins site is not reporting new numbers for the US. They also removed cases from confirmed in Michigan. Not sure what's going on. Yeah, they're trying to prevent a panic as long as they can. But the unfortunate part is that you can hide test data. You can prevent the test kits from going out. What you can't stop is going to be a bunch of people flopping over dead from this virus. Robert Blackburn says, if you haven't already, he wants to know, why isn't the TLT going up yet? So we have, I think this is really the best answer. So oil is at 32 from the Russians and the Saudi Arabians just doing an oil war right now. That puts a lot of people out of business. Okay, so most people need it up above 45 and really do well when it's up in the 60s. 30 is very, very bad. Okay, so anybody who was using derivatives to play the oil market, like selling put options against oil, got crushed. Anybody who was over leveraged lending money to shale producers, especially US shale producers, is crushed. Anybody who's selling put options against the stock market is crushed. And when you go into a trade where you sell a put and then it gaps lower the next morning, that puts you in a predicament where you haven't just lost 100% of your capital. Now you're in a situation where you're negative beyond 100%. So now you're really causing the financial system a huge, huge problem. Okay, so that's what happened this week with the massive crash in oil and stocks at the same time. A lot of traders, a lot of banks, a lot of small banks, a lot of investors were using a strategy, a short volatility strategy that has imploded. And now they're talking about South Korea has a ton of exposure to the same strategy. So as volatility got lower and lower, they started aggressively selling more and more put options. And then when you gap down, you wake up not down 100%, you're down 300, 400, 500%. So you're negative by 3, 4, 5 times your total assets. So what happens is you have to liquidate everything. So that's what happened this week is people had to liquidate everything. And that's why TLT should be up after we predicted this huge stock market crash, but it wasn't. People had to sell all their assets to cover the losses. And so I'm sure we'll start hearing the stories about who went under. I bet the big banks gobbled up a lot of their smaller competition from this. Mark says, who's going to mine the gold? A bunch of men with masks, probably.
Hey, Jason.
Hey, Scotty.
Hey, I work for Kellogg and we have a satellite office. I live in New York, but we have a satellite office in Pennsylvania. And we just got 2 emails that the Commonwealth of Montgomery County of Pennsylvania is shutting down all schools, community centers, gyms, entertainment venues for the next 14 days in an effort to stop the spread of the coronavirus. More notification will be given. It's got all kinds of examples. And then I just got an email issued from our office in observance of the Montgomery County coronavirus announcement. We're shutting down all activities at our Philadelphia office, basically, and issuing everyone to work from home until further notice.
Yeah, we're at the tip of the iceberg. We had blowouts in multiple markets this week that caused people to liquidate everything, and it's making it confusing what's the right investment, because the investment that should have paid off this week did not, and that's because of insolvencies having to liquidate everything. But the bottom line is, if you got low oil, you got a crashing stock market, you've got a healthcare system that's about to be overblown, you got airliners who are going to go bankrupt, you've got industry being stressed. And this is just the start. We're like in the first week of these companies being stressed. Then you know what to do. And that's buy bonds if there's rate cuts and buy gold if there's quantitative easing. Now, normally they do one and then the other, but this crisis is so tremendous that they're doing both. So here's your oil crash. And that was fast. I mean, nobody saw that coming. From 60 to 32. If you had sold a 55 on the crude oil and then it crashed 50, 45, 40, 35, 32. Let's see, what was the low print? 27. Oh God, you just lost a fortune. So that's what can happen if you sell naked puts. You lose more than your total capital.
I tried it, Jason. Those cash secured naked puts, and I even tried it after you warned against it, and it was in oil. It was USO, and that was just me thinking it was a great strategy because how low can it go? But we just learned it can go a lot lower.
Yeah, so I believe this was designed to take out U.S. oil specifically. Yeah, look at that. And so if Russia continues to punish oil and China starts blocking our supply chains, plus we're having our own economy slow down because of everybody getting sick, plus our healthcare system gets overran. I mean, that's what's coming down the pipeline. So where's the money going to flow? You just got to ask yourself, where are the resources going to be allocated? You know, ask yourself, do you think people are going to buy US oil? Well, not if oil's at 30. They're not going to go there. Are investors going to buy a stock market? Well, do you really think the underlying cause for the stock market to sell off is resolved? Or is it just getting started? I would say it's just getting started. Okay. So what comes next? Well, I would argue fiscal stimulus, massive fiscal stimulus to bail out key industries, keep labor force alive. Who's going to pay for that? Well, we're not getting much tax receipts. We just delayed all the taxes. So how's the government going to bail out all these people if they're not even collecting taxes? Well, they're going to have to issue bonds. How are we going to get people to buy bonds? Well, let's think about that. If we want to get people to buy bonds, there's really two ways to go about it. If we want people to buy US if if I'm going to buy a bond from the government, there's only two ways you're going to attract me to do it. Number one is you pay me such a high yield that I'm happy with that for the period of time. Okay, I don't think many investors want to make between 40 basis points and 1.4% a year for eternity. It's not going to cut it. So either they need to allow this yield to spike. Okay, but the problem is US has a lot of debt. Okay, and a lot of people bought at rates that are not attractive. So if you let that yield spike, then investors in the US bond market are stuck at a yield they don't like, and their bonds losing value. So they're either going to hold a yield they don't like, or they're going to sell. So that's not a good solution. So really the solution to attract bond investment is the classic play they've done in every stock crash for the past century, okay? So if we have economic problems, the government has to bail out parts of the industry, the economy. We attract bond investments by cutting rates. At the end of the rate cuts, we do quantitative easing to take those bonds off the investors' hands for a profit because the rates have gone lower. Then the banks come in and buy up the stock market at a discount. It's the playbook they've done in every single stock crash. So I do believe that the same thing will repeat itself here.
So Jason, a question. What is the incentive for people to buy bonds if the interest rates on the bonds are going to be low?
Right. So yeah. So look, here's your treasuries. Here, okay. Red line is federal funds rate. Okay. Tell me what you see the red line doing over time. Is it going up or down?
Down.
Okay. So red line's going down. And what's the yield on the treasuries doing?
Following along.
Okay, so now let's go look at TLT. So this image is from 2018 to 2020. So what has the TLT done? Okay, so as we cut rates, what has the TLT done? And most of those rate cuts happen right here, obviously. So, yeah, it'd be a whole lesson to understand that relationship. But if the yield goes lower, then the bond price goes higher. Okay, so TLT goes up if interest rates go lower. And in fact, since they started cutting rates, it's gone up 28%. Does that make sense, Rocky? So unless you think we don't have a stock crash, or we're not going to use the same playbook we've used for every stock crash for the past century, then this is the play you want to make. So again, each of these gray lines represents a recession where we have had stock crashes. And you can see this is the federal funds rate. So they cut rates that incentivize investment into bonds. Bonds go to the government. Government bails out the industries that are hurting. Once the underlying problem is resolved or the losses are absorbed into the economy, they eventually hike interest rates back up. Before they hike interest rates up, they do quantitative easing. And that's really just a vacuum to pull up all the bonds, which are super low yield, and allows the people who invest in the bonds to get out for a profit. As these people take their profits out of the bond market, it's mostly banks who understand this, they go up and gobble up stocks that are now 50% off. So they've done this once, twice, 3 times, 4 times, 5. They do it about every decade. Buy the bonds, cut the rates, sell it to the Fed. Can't beat that. You know, the Fed's guaranteeing you a profit, if you
Yeah, but
understand.
I think the reason people go and buy bonds is because they are out of the stock market. They've got the money. Bonds still give you some incentive, right? Because they have got some, yield. The yield is not negative, and hence people go and buy bonds. Even the yields are coming down.
Nope, that's not why they buy bonds. So yeah, there's been parts of history where the yields are so high that it might be worthwhile. Let's just see, when's the last time you might have bought a bond that was attractive? Probably if we go back to the 80s, maybe. Let's see if we can go that far back.
Individuals who buy bonds tend to buy things like municipal bonds and some things like that, not treasury bonds.
Yeah, so bonds have a double payday aspect to them. They generate a fixed income, but if the interest rate goes lower, you can flip your bond for a profit. So there's 2 reasons to buy bonds. And yeah, I mean, if we had, imagine getting 8% a year on a 30-year bond in the 90s. Now that is a bond you would buy and hold, right? Okay, so there's been plenty of times in history where you could get a killer 30-year bond, 8%, 8%, 8%. But that's not the world we're living in now. As you can see, what's the general trend? They're just going lower and lower and lower and lower and lower. So you got to ask yourself, why do these rates keep going lower? And now we're at relative all-time lows. So what do you think would actually make these yields go up significantly? Can anybody guess what would make them go up? Oh, let me get back to that, sorry. How would we get yields back up to, let's say, a fair 5% a year? That's a decent, right? 5% a year, that seems fair. For 30 years, it's about 2 to 3 times the expected inflation rate. That would probably just attract money all on its own, right? If you weren't greedy, didn't want to worry about the stock market's return, 5% is not a bad deal. But who on God's green earth is going to buy a bond for 1.5?
Someone who is happy to get their dollars back.
Yeah. And doesn't think there's inflation, apparently.
Yeah, that's where I was going with it.
Yeah. So Rocky, people are buying the bonds for the last several years. I mean, look, 2, 3. Just what's the trend of the yield here, guys? The yield's going down.
I think I fixed some other stuff on there. I didn't really upgrade her.
Oh, okay.
Because Windows 10, I said, well, I would upgrade to Windows 10. But Windows 10, I didn't want to upgrade her yet at that time because Windows 10 still had problems.
Yeah.
And
you should probably get confused on Windows 10 anyway.
Well,
Hey,
no,
open mic. If you're talking about Windows 10, turn your mic off.
I got him. So yeah, Rocky. So yeah, back in the 90s and 80s, you would buy that bond because it's a great deal. Plus, if they did cut rates, you make even more money. Today, you buy a bond and there's no real reason to buy it for the yield. That's less than inflation. So the only reason anybody would buy a bond today would be to flip it to the Fed after they're done cutting rates. So that's the bottom line there. This is the last bond product standing with a decent yield right here. So I'd expect in short order, we're back to 1 and back at the 180 level on the TLT. Oh shit, this computer's crashing. All right, last question. Who's got the last question for the day? Jim Wills says, patience is a virtue. You have it. Good teaching is a skill in which one needs to understand the student's grasp, yet not appear patronizing. You are a master. Oh, thanks, Jim. I appreciate it. But yeah, you know, we all show up when we're up. We all show up when we're down. And we're down very, very little if you're following the program. And I think we're about to get our jackpot here. So. All right, guys, I'm gonna go ahead and close this out. Any last question before I do?
Hey, Jason, I just got off a couple of phone calls. Did you just run through all the options for the testimony, or for, I'm sorry, for the trial people?
Oh, sure. Let's see. Do we have? Is this all? I think we've got almost all clients on here right now.
Let's see here. Hey guys, if you're on a trial, will you just raise your hand or unmute your microphone?
Might have a few. I'll run through our products really quick.
Hey, Mike. Okay, cool. Thanks, Jason.
Sure. Okay, so this is our options page, and we essentially have 4 products. The first of which is delivered weekly on Monday, the buy and hold portfolio. It's really designed for smaller account sizes below 30,000, and it uses no options. So it's very easy, passive, hardly touches the portfolio. And it does, we do have a chat box there. So if you want to chat to Dean at any time, he's always got that up. We have what we call the basic membership. That's what we trade Monday, Wednesday, Friday. Normally it's trading equities, which everybody's familiar with, not a big learning curve of what the hell bond market is. And that portfolio has done quite well. This year we saw a crisis unfolding well before the crowd had been screaming and yelling a stock crash was going to come. So we've been playing this market very safely with some TLT call options and a couple GLD call options recently. So that's not usual. And again, in this program, when the time is right, our intention is to pick up healthcare, biotech, and medical supply ETFs, let that really appreciate, and then we'll get back into the SPY. So that's kind of what you could expect in this program. It does not have an underlying bond asset, which I do believe will be the single easiest way to make money in 2020 and 2021. This is good for portfolios between $30,000 and $75,000. The best product we have is the Pro system. It's a little bit to grasp the bond market. Once you get it, once you understand there's a constant war of money being pulled back and forth between the government and the private sector, which is your bond market and your stock market, then you can understand why owning half your assets in both of these classes can really take the volatility out of your portfolio. So right now, our Pro system is stepping aside from the stock market, just like our basic program, but it's ready to jump into stocks at the right time. It does have half of its asset invested into the actual underlying ETFs and not just using the call option market like our basic system. So right now, this one has about half of its portfolio in bonds and gold, plus it's placing aggressive call option trades into to the bond market. The bonus we have today is if you do join, we're gonna throw in a free 30-day access to our boot camp. This is a boot camp that operates Tuesdays and Thursdays. Tuesdays, I give you information to study and sometimes trade alerts. For example, we put out a QQQ put that's up substantially for our boot camp members. That one is up. It was up almost, I can't remember what it was up. What do you guys know offhand?
It was pushing 250, 300% somewhere around there yesterday.
Yeah, so that trade's still open. So we do some speculative hedging with the boot camp, but the main reason to join it is the education. So Tuesday, Thursday are the days we give you content for the boot camp, and also teach you how to fill out a spreadsheet just like mine, so you can track your results like a hedge fund trader. and have it very organized and broken down. And again, this is a 30-day bonus if you do decide to upgrade into our packages.
Excellent explanation, Jason. Thank you very much, bud. Appreciate it.
Anwar says, what about the SPY today? What's the question about the SPY?
Any trades for the SPY, on the SPY?
No. So let's review the trade alert. It's always good to refer to the trade alert. So step 1, do not buy the SPY. We're waiting for the crash to go far further. Step 2, hold all TLT call options plus GLD calls. Next week, the Fed likely cuts rates. That's bullish for TLT.
Can I ask you before you go down, because I'm new, what do you mean by 3.20, 3.27, 4.3? What are those?
Oh, okay, good question. March 20th,
Oh,
March 27th, April 3rd, April 9th. So we've been slowly investing into this trade over the last several weeks, expecting that the Fed will cut interest rates, which is what we want for this trade alert to pay off. So they did a 50 basis point rate cut emergency. And now I believe next week they will do a much larger cut. So that's really the speculation of these trades right here. In terms of equities, stocks that I do want to purchase, there's 3 healthcare ETFs. One is just general healthcare, like Johnson & Johnson. The other is a biotech, like, how do you say it, Dean? Is it Gilead or Gilead?
Gilead. Yep.
Gilead's the biggest position in that. And then medical devices is the 3rd ETF. So as soon as I do believe the crash is over or nearing a bottom, we're going to do a very similar trade as this one. Okay, so it's important that we do learn this concept. So we're going to be seeing stocks down tremendously. Blood in the streets, as the Rothschilds would put it. And the way we'll enter is with something of this nature called the married put. So I do want to get the other half of your portfolio back into equities as soon as possible. But first we need to see the rate cuts occur, which will single-handedly drive capital to bonds and probably really expedite the crash, unfortunately. A lot of people think rate cuts solve a stock market crash, and that's very misleading. Which again, you can see that because what happened in every stock crash? Rate cuts. So I don't know why people always say that, but yeah, rate cuts essentially force the value of bonds to appreciate, which is what you're seeing in this chart. So we started doing rate cuts last year. It continued to do so. So you can see so far we've had a 28% return on TLT since they began doing rate cuts. And my belief is that they're just getting started. Mark would like to get into all the old content. Sure, yeah, I'll make sure to get you all the links and everything. Did you get the Tuesday mailer, Mark? That's the best one to read right now. And it has links to everything. I would go to your email and search. Okay, also, I can't see which Mark this is. Can you post your email just so I could pass it to Ryan?
Yeah, and guys, just if you can, when you log into Zoom, please, if possible, can you just type in first and last name? It really helps us identify who's who.
Yeah, I think there's about 3 marks on here.
Yeah.
Oh, Mark Marinick. Hey, how's it going, buddy? Haven't heard from you in a while. All right, guys, let's see. You're still getting through the divorce? No way. Holy crap. That's been going on for a year now, hasn't it? Over 600,000 loss. Oh man. I'm sorry, buddy. It's not fun emotionally, and it's sure not fun financially. So are you getting to see your kids at least? $50-50. Oh, that's good. All right, guys. Well, we went for 2.5 hours and lots of good questions. Even though some of us are making a couple little errors, I think now's the time to learn them so that we don't make them in the future. And hopefully we're all following the plan and not part of the plan, because it really is a strategy that takes care of your full portfolio. It doesn't work in bits and pieces. So it is important to actually follow the full system and not part of the system. So this exact strategy is how we will get back into equity exposure, where we buy the asset, but we protect with a put. So I think that's really critical that, for example, here's one ETF that I would like to become heavily exposed to with their stock portion of our portfolio, which is XLV. Let me just zoom out a little bit. Okay, so this will be falling off a cliff when I tell you it's time to get in. And we're going to protect it with the married put. Expecting a big bounce, but momentum going against us. That's how you buy things that are falling off a cliff safely. You buy it, you buy a put, and then you don't have to worry about how much more downside momentum there is because you own the put option. So that will be the exact strategy of how we deploy our equity portfolio when the time comes. So I'll be looking for the stock market to crash a lot further. And then I'm going to be listening to the government in terms of their spending plans. And as soon as they start talking about spending massive amounts of money to fund healthcare, biotech, medical supply companies, then right around that time, once they start discussing it, is likely when these will start to bottom out, because investors will realize they're about to get huge amounts of capital and profits directly from the government. So that's what we're looking at to deploy the cash portion of your portfolio that's designated for the SPY. I think we're going to make more money in healthcare at first. Once that does find a good price tag, then we could consider going into the SPY. So good lessons today. Hopefully everybody understands the married put, why we buy a put even though we're betting up. It's to protect against downside risk. And this is a simple strategy that's very effective for buying assets that are, again, the momentum's going against you, you're betting on it, reversing and trading higher. Jim Willis says, should we look at inverse funds like SQQQ? Well, see, if you had bought the SQQQ yesterday and held it, you would be down 15% today. Because it's a 3-time leverage. I mean, you might be down more than that. I don't know what QQQ is up. Let's see, QQQ is up 2% today. So you'd be down 6% today. So when volatility is low, you want to buy put options. So in our boot camp, we bought a out of the money put to play that big move on the QQQ. The safer way to bet on downside in the stock market right now is to buy call options on the TLT. So you're not going to get whiplashed around with manipulation. And right now the VIX is, well, let's see. VIX is expensive, 65. So I wouldn't be messing with that kind of trade right now. And again, my goal is to deliver low volatility. So this is this has got to be the biggest drawdown we've ever had, 2.4%. Okay. And I don't think we'll close. I would be very shocked if I end this month with the loss. We were up 15% on Monday, which is absurd considering how little we've risked to do so. But we got quite likely rate cuts next week, continued stock crash, and the hospital system getting overran. So I'm really quite confident in our positioning. So at all times, we will be making the investment that has the least risk to the downside and still has the obvious potential profit. So most people are down anywhere from 20 to 30% this year. We were up 15% on Monday, and I think we'll be well beyond that by the end of the month if my predictions are correct that we have trouble ahead. So this is the way to do it with the least volatility and playing the safest market. So that 30-year treasury is protected by literally the US government and the central bank. The stock market is being left for free fall, but it's having a lot of volatility. So if you go buy a product like SQQQ, then you could do that, but you better be willing to have a lot of volatility in your portfolio. So TLT call options, a safer way to do the SQQQ. All right, Ryan, let's go ahead and wrap it up. We'll see you guys on Monday. I hope everybody has a great weekend. And stay safe, stay healthy, and we'll see you on Monday.
Thank you, Jason. Thank you, team, for joining us today. If you're on a trial and you have any questions, any additional questions, please feel free to call me, 505-322-7515. Have a wonderful weekend. Stay safe, folks.
Thanks, Dean. Thanks, everybody.